Mike, the Fed cut rates again, as we talked about, which usually is rocket fuel for risk assets. But then Powell says to everybody, let's not get too excited. What's your take here? Was this just the market overreacting, or is Powell intentionally keeping everyone on edge right now? What do you think?
Well, I have a little bit of a different view than you on this, which is I actually don't think these rate cuts really matter. This is the
Tell us.
Fed funds rate. And the Fed funds rate is, banks loaning. It's incredibly short term. It's going to hurt people with money market accounts or any of the savers that are out there. But the real interest rate, and the thing that I like to watch, is the 10-year yield. The 10-year yield is determined by the free market, not the rigged market. And, everyone wants to talk about Powell cut, 25 bips, and then the 10-year yield spikes. Well, how does the 10-year yield go up on a day or in a time where rates are coming down? And that's because the market doesn't buy it. And when you think about what's kind of tied to the 10-year yield, that's your home, that's your mortgage, that's your auto. It's incredibly more important than 25 bips in the short term. So I don't think the market's buying it. I actually don't think that that is why Bitcoin tumbled. I don't think that it has anything to do with it. I just think that overall the markets have been very jittery. I mean, it's an incredibly split tape right now. You've got maybe 7, 9 names that are 65% of the S&P 500. You've got 494 names that are basically 35%. So they're holding those up pretty good. It makes the indices look good. But if you're watching earnings, we're in earnings season right now. I mean, we're in the thick of it. We got a couple of big ones today after the market. But you're seeing blowups. I mean, they're not the most important names that are out there, but things like Garmin, Fiserv in payments, some of these stocks were down 40% yesterday on their earnings. I had a couple that were in the 50s, and everyone wants to say think long term. And they're going after the defensive stuff, the household goods, tobacco, household products, General Mills. Big bear markets look terrible. Retail looks awful. Restaurants look awful, and they're slowly getting them. And that's kind of what happens. So you have a few stocks like Nvidia and some other things that are just hitting all-time highs and are doing really well. And it definitely masks a lot that's going on under the hood. And when you really do dig deep into the consumer is very price conscious right now. That's the fact of the matter. Something like Lululemon's probably down like 70-some%. There's a lot of big bear markets out there. Starbucks, things like that. People are price conscious. Now, right now, they're holding up the big banks. And there's never been a bear market where the big bank stocks have held up. So right now, the big bank stocks are in decent shape, and there's a few things kind of holding up the indexes. But if they go, it's going to be a problem. I mean, Meta blew up yesterday after earnings. So I don't really think that it's necessarily because of a rate cut or an interest rate decision in one way or another. I think that Bitcoin is still a risk-on asset. Maybe it's overheated a bit. And it's due to pull back, and a lot of things are performing a lot worse than Bitcoin. As much as it's frustrating to see it drop so quickly, I think that it's going to be fine. And really, I want to see what happens with the real interest rates as we move forward.
Yeah, and to your point, it is right now. I actually saw an article about it yesterday. It's like the Mag 7. There's like 7 companies right now that are just sloshing like $1 trillion between the 7 of them. That seems to be propping up the whole market. So part of me is wondering if like people, despite the recent gains we've seen this year, if people are starting to realize that like maybe we're on a lot more shaky ground than the numbers are telling us right now. And we'll see how that plays out. Through the end of the year in Q4, like you said, is usually where the numbers get made. And you yourself have watched how Bitcoin reacts to policy over multiple cycles now. So, Mike, how different does it feel this time, where Bitcoin seems to be behaving maybe more like a macro asset than a tech bet right now? Do you feel a fundamental difference in this cycle than you have in previous ones?
Absolutely. And the main difference is there's just so many buyers. There's so many buyers, and it doesn't feel like we've hit any kind of euphoria or exuberance. If anything, I think, I'm reading things, people think it's going down to 60 and people think everything is going to crash. And that's great because usually when everyone thinks that, we're going to rip higher and everyone thinks that, that never happens. Usually what everyone thinks is going to happen is never going to happen. If you manage money or if you invest in stocks or whatever yourself, when everyone thinks it's going to be a blowout, amazing earnings report and you pick up a few options, that never goes well, right? And the last time Bitcoin, hit 70,000 before FTX and everything else, everyone thought it was going to 100. So I would much rather be in an environment where everyone thinks we're going back down to 50,000 or everyone thinks, is freaked out by the price, because that usually means we got a lot of room to run. The other thing on that announcement yesterday, the ending QT, the liquidity floodgates, December 1st, for whatever the Fed's program is that they're ending. I'm not a big macro guy, but I believe that sets it up for a positive 2026.